This is a dramatized story inspired by real debt situations. For educational and entertainment purposes only. Not legal or financial advice.
$78,000. That's what I owed when the bank froze my business account on a Tuesday morning in March. I was 43 years old, and I had nothing left to show for 6 years of work. Just a mountain of debt, a lease I couldn't afford, and a phone full of calls I was too afraid to answer. By the time it was over, I'd lost the business, maxed out 4 credit cards, fallen behind on our mortgage, and started lying to my wife about what was in our bank account. I told myself it was temporary. I told myself I was protecting her. But the truth is, I was drowning, and I didn't know how to ask for help. What happened next didn't fix everything overnight, but it changed the direction. And if you're sitting somewhere right now staring at a number that doesn't make sense, I want you to stay with me, because some of what I learned might matter to you too. My name is Marcus. I'm 43 years old, and for the last 3 years of my life, I ran a small HVAC repair and installation company in the suburbs of Columbus, Ohio. At our peak, we had 7 employees, 2 service vans, and a commercial lease in an industrial park off Route 40. I was bringing home around $72,000 a year after I paid my crew. My wife, Dana, was a registered nurse working 4 shifts a week at a regional hospital. Together, we thought we were solid. We had a 15-year-old daughter, a 3-bedroom house in Westerville with a $1,640 mortgage, and a plan. That plan lasted until COVID hit, and my 2 biggest commercial contracts, a property management company and a school district, both suspended services indefinitely. Within 90 days, my monthly revenue dropped from $34,000 to under $8,000. I kept paying my crew as long as I could. I kept paying the lease. I used my business credit cards to bridge the gap, telling myself things would rebound by fall. They didn't rebound by fall. By January of the following year, here's what my debt looked like. Business line of credit, $22,400. Personal credit card, Chase Sapphire, $1,700. Personal credit card, Capital One, $11,200. Personal credit card, Synchrony, $6,400. A personal loan I'd taken from a local credit union to cover payroll, $9,100. And a second mortgage, a home equity loan we'd taken out 2 years earlier to buy the second service van, still carrying a balance of $10,500. Total, $78,000, not counting our primary mortgage, not counting the 2 vehicle loans on the vans, $78,000 in revolving and installment debt, and I was no longer generating the income to service any of it. I started missing payments in February. First the business line, then the Synchrony card, the one with the highest interest rate, 9%. I told myself I'd catch up. I didn't catch up. By March, the business bank account was frozen due to a default notice on the line of credit. I found out when I tried to pay my lease and the transaction declined. I sat in my truck in the parking lot for 45 minutes before I drove home. I didn't tell Dana that day, or the next day. That's when the hiding started. I intercepted the mail before she got home from her shifts. I moved our joint savings, about $4,200, into a separate account so she wouldn't see it draining. I told her work was slow, but picking up. I told her the business was in a restructuring phase. I used words that sounded like progress, but meant nothing. At night, I'd lie awake next to her running the numbers in my head. $78,000 at an average interest rate of somewhere between 22 and 28%. That's roughly $1,400 to $1,800 a month in interest alone. On a good month, my reduced income was maybe $3,500. My share of the household bills, mortgage, utilities, groceries, my daughter's car insurance was another $2,800. The math didn't work. It hadn't worked in months, and I kept pretending it would fix itself. The collection call started in April. My cell phone would ring before 8 a.m. I'd silence it. It would ring at noon while I was trying to get a job quote signed. I'd let it go to voicemail. By 6 p.m., I'd have 6, 7, sometimes 9 missed calls from numbers I didn't recognize. 614 area codes, 800 numbers, blocked numbers. The voicemails were polite at first. "This is a call regarding your account. Please call us back at your earliest convenience." Then they got more direct. "This is a final notice before your account is referred to a collection agency." A collection agency. That phrase hit me like cold water every time I heard it, because I knew what that meant. It meant my credit score, which had been around 710 just 18 months earlier, was about to fall off a cliff. And I knew that a damaged FICO score doesn't just mean you can't get a credit card. It means landlords reject your rental application. It means car loan rates double. It means the financial margin you thought you had, and that invisible cushion, disappears completely. Dana found out on a Saturday in late April. She'd been trying to refinance her car loan to get a lower rate, and the bank ran her credit. The joint account showed delinquencies, 3 of them. She called me from the bank parking lot. "Marcus, what is this? Why does it say we're 60 days past due on 2 accounts? Why didn't you tell me?" I didn't have a good answer. I had excuses. I had explanations. None of them were good enough. She came home and we sat at the kitchen table for 2 hours. I showed her the spreadsheet I'd been keeping hidden on my laptop. Every account, every balance, every missed payment. I watched her face go through 5 different emotions without her saying a word. When she finally spoke, she said, "How long have you been carrying this by yourself?" 5 months. I'd been carrying it alone for 5 months. That night was the worst night of my life. Not because we fought. We barely raised our voices. It was worse than that. It was quiet. She slept in our daughter's room. I sat at the kitchen table until 3 a.m., staring at that spreadsheet, and that's when I made the first of several bad decisions. I went online and applied for a payday loan. Bought on $500 due back in 14 days with a $225 fee. That's an annualized rate of over 390%. I told myself I just needed to stop the bleeding on one account. I used it to make a minimum payment on the Chase card. 2 weeks later, I couldn't repay the payday loan, so I rolled it over. Another $225. Then I did it again. In 6 weeks, that $1,500 cost me over $700 in fees, and I still owed the original principal. It solved nothing. I also tried a balance transfer. I found a card offering 0% APR for 15 months on balance transfers, and I moved $8,000 from the Capital One card onto it. What I didn't account for was the 3% transfer fee, $240 upfront, and the fact that my credit score had already dropped enough that the card I thought would give me a $12,000 limit only approved me for $8,500. So I hit the limit immediately, and with my utilization at 94%, my credit score dropped another 30 points. Balance transfers can be a legitimate tool when your credit is still healthy and you have a real plan to pay off the balance before the promotional period ends. I had neither. I also rated my 401k. This one still stings. I had about $28,000 in a rollover IRA from a previous corporate job before I started the business. I took out $14,000. The IRS considers that ordinary income, and because I took it before age 59 and a half, there's a 10% early withdrawal penalty on top of regular income tax. By the time I processed what that actually cost me, I was looking at losing nearly 35% of it to taxes and penalties. I got $14,000 out of the account and effectively lost almost $5,000 of it to the IRS. Do not raid your retirement account in a panic. Please, talk to someone first. The mail piled up. I stopped opening envelopes. My daughter once asked me why there were so many letters on the counter, and I told her they were business documents. She was 15. She wasn't fooled. Kids never are. The turning point came in a way I didn't expect. Dana came home one Tuesday evening with a printout. She'd been talking to a coworker at the hospital, another nurse whose husband had gone through a significant debt crisis 2 years earlier. Her coworker had given her the name of a nonprofit credit counseling agency, a legitimate one, accredited by the NFCC, the National Foundation for Credit Counseling. She set the paper on the kitchen table in front of me and said, "I'm not doing this alone, but I'm also not going to watch you disappear. Call them." I called them the next morning. The counselor I spoke to, her name was Renee, didn't make me feel like a failure. She asked me to walk through every balance, every interest rate, every monthly minimum. She was taking notes. When I finished, she was quiet for a moment, and then she said, "Okay, I've heard worse. Let's figure out what your options actually are." Settling in, educational, but through Marcus's voice, Renee explained 4 main paths people in my situation usually consider. I want to share what she told me. Not as advice, because you should absolutely consult a licensed professional before you make any decisions, but because I wish someone had laid this out for me 2 years earlier. The first option was a debt management plan, or DMP, through the nonprofit credit counseling agency itself. In a DMP, the agency negotiates lower interest rates with your creditors, sometimes significantly lower, and you make one monthly payment to the agency, which distributes it to your creditors. You typically have to close the enrolled credit card accounts, which does affect your credit score in the short term, but it's not a legal proceeding. It doesn't appear on your record the same way bankruptcy does, and it keeps you out of court. Renee said many of her clients in my situation saw their interest rates reduced from 24 to 27% down to 6 to 9%. For someone carrying $40,000 to $50,000 in credit card debt, that difference in interest alone can save thousands of dollars over the repayment period. The second option was debt settlement. This is where either you or a for-profit debt settlement company negotiates directly with creditors to pay a lump sum that's less than what you owe. Creditors sometimes agree to this, especially on accounts that are already severely delinquent, because something is better than nothing. The risks are significant, though. Debt settlement companies often charge 15 to 25% of your enrolled debt as fees. Your credit score takes major damage during the process because you're intentionally letting accounts go delinquent to force creditors to negotiate. And any forgiven debt over $600 may be reported to the IRS as taxable income. That's called a 1099-C, and it can create a tax bill you didn't expect. Renee said she'd seen people get blindsided by that. The third option was Chapter 7 bankruptcy. Chapter 7 is a liquidation bankruptcy. A bankruptcy attorney files on your behalf. An automatic stay goes into effect immediately, which stops collection calls, lawsuits, and wage garnishment while the case is processed. Most unsecured debts, credit cards, personal loans, medical bills, can be discharged entirely. The process typically takes 3 to 6 months. The serious downside: a Chapter 7 bankruptcy stays on your credit report for 10 years. It may impact your ability to get certain professional licenses. And to qualify, you have to pass what's called the means test. Your income has to fall below a certain threshold relative to your state's median income. With Dana still working full-time as a nurse, our combined household income might complicate qualification. The fourth option was Chapter 13 bankruptcy, which Renee thought might be more applicable to our situation. In Chapter 13, you don't liquidate assets. Instead, you propose a 3 to 5 year repayment plan to the court, paying back some or all of your debt at a structured, manageable rate based on your disposable income. The automatic stay still applies. Calls stop, lawsuits stop. And critically, Chapter 13 can help you catch up on mortgage arrears, which meant it might protect our house. The Chapter 13 bankruptcy stays on your credit report for 7 years rather than 10. It's more complex. You need a bankruptcy attorney. There are court fees and attorney fees. But for someone with regular income and assets they want to protect, it can be the more strategic path. I kept thinking, I should have known all of this 18 months ago. Not to use it necessarily, but to know it existed. To know there were structured options with real legal protections. Instead, I'd been cobbling together payday loans and balance transfers like I was trying to plug a dam with my hands. Always consult a licensed professional, a bankruptcy attorney, a certified credit counselor, before you decide which path is right for your situation. Every situation is different. Income, assets, the types of debt you carry, whether you're behind on a mortgage, All of it matters. After 2 sessions with Renee and a consultation with a bankruptcy attorney she referred us to, Dana and I decided to pursue Chapter 13. Our attorney filed in July. The automatic stay went into effect within 24 hours of filing. My phone went quiet. I'm not exaggerating when I say I stood in my kitchen that first morning and just listened to the silence. I want to be straight with you about where things stand, because this isn't a story where everything got fixed. We're 14 months into the Chapter 13 repayment plan. We have roughly 46 months remaining. Our monthly plan payment is $1,180. It's tight. Dana picked up an extra shift every other week for a while to help us stabilize. I closed the business officially. That one hurt more than I expected. I've been doing independent HVAC service work on a 1099 basis while we work through the plan. It's not what I imagined for myself at 43, but it's honest work, and the phone isn't full of collection calls anymore. Our FICO score is rebuilding slowly. We opened a secured credit card 6 months ago. $300 limit, paid in full every month, specifically to start demonstrating positive payment history. Our attorney told us that consistent, on-time payments during the Chapter 13 plan period actually help some people begin credit recovery earlier than they expect. My daughter knows what happened now. We told her most of it. Not everything, but enough. She handled it better than I expected. She's 16 now. She asked me once if we were going to lose the house. I told her no. And for the first time in 2 years, I could say that with something behind it. Dana and I went to 2 sessions of financial counseling together. Required as part of the bankruptcy process, actually, but we kept going after. We've built a zero-based budget. We talk about money now in a way we never did before. That part, the communication, I think that's the thing I'd tell anyone who's hiding debt from a spouse. The secret is heavier than the debt. Put it down. If you're somewhere in the middle of this right now, behind on payments, dodging calls, lying awake doing math that doesn't add up, I want you to know that there are structured options with real legal protections. A nonprofit credit counselor through the NFCC costs little to nothing for the initial consultation. A bankruptcy attorney consultation is often free or low cost. You don't have to figure this out alone at a kitchen table at 3 a.m. It doesn't fix overnight. 46 months is a long time, but there's a difference between drowning and swimming slowly. I'll take swimming slowly. Get the free debt checklist in the description. It walks through the exact questions I wish I'd asked before I made those early mistakes. Link is below. And if this story sounded like someone you know, or like you, subscribe, because we're going to keep telling these stories.